Welcome to Deep Dive. Welcome. We're thrilled to have you here. Let's dive in and grow together.
Welcome, everyone, to our deep dive into one of the all-time great investment books, The Intelligent Investor by Benjamin Graham.
Yes, a true classic.
It really is. And today we're going to be breaking it down so you can really understand and hopefully apply Graham's wisdom to your own investing.
It's amazing how relevant his ideas remain, even decades after the book was first published.
It really is. So for our listeners out there who have maybe never even picked up the book, tell me a little bit about who Benjamin Graham was. Like, what kind of a guy was he?
He was a fascinating character. He actually, after graduating from Columbia back in 1914, he had the opportunity to, pursue a career in academia.
Really?
But instead, he chose to go to Wall Street.
Wow. So he chose the Wild West of finance over, like, the ivory tower?
He did. And his early experiences there really shaped his whole investment philosophy.
Oh, I bet.
He had some incredible wins, but also some pretty crushing defeats.
Oh, I'm sure.
For example, he once made a 250% return on his first day trading a stock called Save Old Tire.
250% in one day. That's insane.
It was. But there's a catch.
Oh, no.
The company turned out to be a fraud, and Graham lost all his profits.
Oh, man. Talk about a roller coaster.
Yeah, it was a harsh lesson, but it taught him the importance of meticulous research.
Makes sense. You got to really do your due diligence.
Exactly. Later on, he spent weeks digging through financial reports, and he discovered that Northern Pipeline Co. held $80 per share in bonds.
Okay.
Yet the stock was only trading at $65 a share.
Wait. So the pieces of paper representing their debt were literally worth more than the pieces of paper representing ownership of the whole company?
It might seem strange.
That's wild.
But it happens. And Graham knew that this was a huge opportunity.
I bet.
He bought as much stock as he could, and then he pushed the management to increase the dividends to shareholders.
Smart.
It worked. The stock price rose, and he ended up making a significant profit.
That's awesome. So he saw the value that everyone else was missing, and he was willing to put in the work to unlock it.
That's really the essence of what he teaches in The Intelligent Investor. He defines the intelligent investor not by their IQ or some special ability to predict the future, but by their temperament and their approach to investing.
So it's not about being a genius, it's about having the right mindset.
Exactly. It's about being patient, disciplined, and willing to learn. It's about controlling your emotions and not getting swept up by the hype or the fear that drives so many investment decisions. Remember the dot-com bubble in the late 90s?
Oh, yeah. How could I forget? Everybody was talking about internet stocks like they were the golden ticket to riches.
And a lot of people got burned badly. The Monument Internet Fund lost something like 80% of its value.
Wow.
And even seasoned investors, like Jim Cramer, saw some of their stock picks lose over 90% of their value.
Ouch. I guess that's a pretty good example of what not to do.
It is. And it highlights the difference between investment and speculation, a key concept that Graham emphasizes throughout the book.
Okay, so help me understand that distinction. What exactly does he mean by investment versus speculation?
For Graham, investment is all about thoroughly researching a company, understanding its business, and determining its intrinsic value, what it's truly worth based on its assets and earnings potential. It's a long-term approach. Speculation, on the other hand, is focused on short-term price movements. It's about trying to time the market, jumping in and out of stocks, often based on rumors, tips, or gut feelings, rather than solid research.
So with speculation, you're essentially betting on the psychology of the market, not on the underlying value of the business itself.
Precisely, and that could be a very risky game. Take the example of the Foolish Four investing strategy.
Foolish Four?
Yeah, it was a simplistic formula for picking stocks that completely disregarded a company's fundamentals. And it ultimately led many investors to make some very bad decisions.
Okay, so if we want to follow Graham's approach and be intelligent investors, how do we actually put these principles into action when we're building a portfolio?
Well, Graham outlines different strategies for different types of investors. He distinguishes between the defensive investor and the enterprising investor.
Interesting. So what are the key differences between those two approaches? Like, who should be a defensive investor and who should be an enterprising investor?
The defensive investor is someone who's looking for a safe and steady approach, one that doesn't require spending hours poring over financial statements. Graham recommends that they aim for a portfolio split roughly 50-50 between stocks and bonds.
Okay, that makes sense. And what about those of us who are, a bit more adventurous, who are willing to roll up our sleeves and do some digging?
That's where the enterprising investor comes in. They're willing to put in the time and effort to research individual companies and potentially find those hidden gems in the market.
Right, like those undervalued companies that everybody else is missing.
Exactly. But even they need to stick to those core value investing principles. Focusing on a company's intrinsic value, not just its stock price, diversifying their portfolio, and practicing dollar cost averaging.
So whether you're a defensive investor or an enterprising investor, diversification and dollar cost averaging are key tools in the intelligent investor's toolkit.
Absolutely. Diversification is crucial. It means not putting all your eggs in one basket. By spreading your investments across different asset classes, industries, and geographical regions, you reduce the impact of any single investment performing poorly.
Makes sense. And what about dollar cost averaging? How does that work?
Dollar cost averaging is a powerful technique that helps you smooth out those market ups and downs. You invest a fixed amount of money at regular intervals, regardless of the price.
So you're not trying to time the market, you're just consistently investing over time.
Exactly. And that can be a very effective way to reduce your risk and build wealth over the long term.
Got it. So we've got our stock allocation sorted out, but what about the bond side of the portfolio? What does Graham have to say about those?
Well, Graham was writing at a time when bonds were a much more significant part of most investors' portfolios. He recommended considering both taxable and tax-free bonds, taking into account your individual tax situation.
Okay.
And of course, the choice between shorter-term and longer-term bonds depends on your risk tolerance and your time horizon.
That makes sense. But wouldn't you say that the bond market has changed quite a bit since Graham's time?
Oh, it definitely has. Back then, researching and investing in bonds was a much more complex and time-consuming process. Today, you have the option of investing in bond mutual funds, which are managed by professionals and can provide instant diversification,
Okay.
mitigating risk and simplifying research for the individual investor.
That sounds like a much more approachable option for the average person. So we've covered the defensive investor, but now I'm really curious about these enterprising investors. What are some of the specific strategies that Graham outlines for them?
Well, he identifies 4 key areas they can explore. First, there's market timing, the classic buy low, sell high strategy.
Yes, the holy grail of investing. Buy when everyone else is selling and sell when everyone else is buying.
It's a simple concept, but in reality, it's incredibly difficult to execute successfully. Even the most seasoned investors often get market timing wrong.
I bet. So what's next on the list?
Investing in growth stocks. These are the companies that have the potential for rapid expansion, often in exciting new industries. Think about, this innovative tech companies that capture everyone's imagination.
Ah, yes, the companies that everyone wants to get in on before they skyrocket in value.
Exactly.
Yeah.
But Graham cautioned investors to be wary of those that are overvalued. Wait for a pullback or a time when the stock is out of favor before jumping in. Patience is key, even when you're dealing with what seem like the hottest companies in the market.
Okay, so patience and avoiding hype are crucial for growth stocks. What's the next strategy?
Bargain hunting. This is all about finding those undervalued companies, the hidden gems that the market has overlooked. It's about digging deep, doing your research, and finding companies that are trading for less than their intrinsic value.
That sounds a lot like what Graham did with Northern Pipeline Co., finding that hidden value that everyone else was missing.
It is, and it's a strategy that requires a lot of patience, discipline, and a willingness to go against the herd.
Makes sense. And what's the final strategy on his list?
Special situations. These are unique opportunities that can arise from things like mergers, acquisitions, or even liquidations. Sometimes these events can create mispricing in the market, and the intelligent investor can capitalize on these inefficiencies.
Interesting. So we've got these 4 strategies for enterprising investors: market timing, growth stocks, bargain hunting, and special situations. But how do we actually go about analyzing these companies to determine whether they're worthwhile investments? How do we get to that intrinsic value that Graham talks about?
That's where security analysis comes in. Graham emphasizes the importance of getting your hands dirty with financial statements, going beyond the headlines and the hype to really understand a company's financial health.
Okay, so we need to look beyond the stock price and dig into the nuts and bolts of the business. But how do we do that? What are some of the specific things that Graham recommends we look for when we're analyzing a company?
He recommends using financial ratios to evaluate things like profitability, financial strength, and stability. You're not just looking at a company's earnings for a single year, you're looking at its track record over time.
So we're looking for consistency, a history of solid performance. Can you give me an example?
Sure. Look at Chrysler between 1952 and 1970. Their earnings were all over the place, fluctuating wildly from year to year.
Okay.
And their stock price followed a similar pattern, going up and down like a roller coaster. This is why it's so important to understand a company's true earning power. its ability to generate profits consistently over time and not get distracted by those short-term fluctuations in earnings or stock price.
Got it. So we're looking for steady, reliable earners, not companies that are prone to those boom and bust cycles.
Exactly. And that's where financial ratios can be incredibly helpful. Graham recommends looking at a company's price-to-earnings ratio, its debt-to-equity ratio, and its current ratio, among other things.
Okay.
These ratios can give you a much deeper understanding of a company's financial health than just looking at its earnings or its stock price.
That's fascinating. Starting to see how all of this fits together. It's about digging deeper, doing the research, and understanding what truly drives a company's value.
That's what Graham was all about. And throughout the book, he uses real-world examples and case studies to illustrate his points.
Oh, that's great. I love a good story. Are there any specific case studies that really stand out?
Several. He talks about NVF, a company that was engaging in some questionable accounting practices to inflate its earnings.
Oh, wow. So it's important to look beyond the numbers and understand the context.
Absolutely. He also dissects the disastrous merger of AOL and Time Warner, a classic example of what can go wrong when companies prioritize growth over value.
Yeah, that was a huge deal at the time, and it ultimately ended up being a massive failure.
It did, and Graham uses it to show what can happen when companies get caught up in the hype and lose sight of their core business principles.
So what other case studies does he use?
He contrasts National General and National Presto, two seemingly similar companies, to highlight the importance of understanding a company's capital structure, the way it finances its operations.
Okay, so even if two companies operate in the same industry, their financial underpinnings can be very different.
Exactly. And understanding those differences can be crucial when making investment decisions. He also discusses the Palm 3Com spinoff.
Palm 3Com.
Yeah, a fascinating case study that demonstrates how market inefficiencies can create really absurd valuations.
What happened there?
So Palm was a handheld computer maker, and 3Com was a networking company. 3Com owned Palm, and they decided to spin off Palm as a separate publicly traded company. But here's the strange thing. After the spin-off, the market valued Palm more highly than 3Com, even though 3Com still owned a significant portion of Palm.
Wait, so the market was essentially saying that the part was worth more than the whole?
Exactly.
Huh.
It's a classic example of how the market can sometimes get it wrong, and that these mispricings can create opportunities for the intelligent investor.
That's wild. It's like finding a $100 bill lying on the ground.
In a way, it is. But it takes a certain kind of mindset to spot those opportunities and the courage to act on them when everyone else seems to be heading in the opposite direction. And that brings us to another important aspect of Graham's philosophy, shareholder activism.
Shareholder activism. I'm intrigued. Tell me more.
Graham believed that shareholders shouldn't be passive bystanders. He felt that they have a responsibility to hold management accountable and ensure that their interests are protected.
So we're not just along for the ride, we actually have a voice in how the company is run.
Absolutely. Think about the Enron scandal. Conflicts of interest and a lack of oversight played a huge role in that company's downfall.
That was a classic case of corporate greed and malfeasance.
It was. And Graham believed that shareholders could have played a more active role in preventing that kind of disaster. He encouraged investors to carefully study a company's proxy statement, a document that provides detailed information about a company's management board of directors and major shareholders.
So the proxy statement is like a window into the inner workings of a company.
It is. And it can reveal red flags about a company's management and corporate governance.
Okay, so don't just skip over the fine print. There could be some crucial information buried in there.
You got it. And speaking of crucial information, one of the most important principles in the SAM, the intelligent investor, has to be the concept of margin of safety.
Now, that's a term I've heard thrown around a lot, but honestly, I'm not entirely sure I understand what it means. Can you break it down for me?
Sure. It's central to Graham's investment philosophy. It's all about buying stocks below their intrinsic value. Think of it as a buffer, a cushion to protect you from potential losses.
So it's like getting a discount on a great product.
Yeah.
You're paying less than what it's actually worth.
Exactly. And that discount, that margin of safety, is crucial for protecting your investment. It's like in 1973, when the Washington Post Company was selling for a fraction of what its assets were actually worth.
Wow, a classic bargain.
It was. And those who recognized the value and had the courage to invest ended up doing very well.
Okay, I'm starting to see how this margin of safety concept works. But how do we actually determine a company's intrinsic value? Is there a formula for that?
There are various methods for calculating intrinsic value. One common approach involves analyzing a company's assets, earnings, and future growth prospects.
Okay.
You can also look at comparable companies in the same industry to see how they're valued. The key is to be conservative in your estimates.
So it's better to err on the side of caution to underestimate rather than overestimate a company's value.
Exactly. Remember, the margin of safety is there to protect you from those unforeseen circumstances, those events that you can't predict.
It's like building a bridge that can withstand a much heavier load than you expect it to carry.
That's a great analogy.
Yeah.
And speaking of building a solid foundation for your investments, Graham's study of super investors of Graham and Doddsville provides some fascinating insights.
Now that sounds interesting. Tell me more about this study.
In this study, Graham looked at a group of investors who consistently beat the market over long periods of time. These were people like Warren Buffett, Walter Schloss, and Charlie Munger, names that have become synonymous with successful investing.
So what was their secret? What set them apart from the average investor?
They all shared a buy the business, not the stock mentality.
What exactly does that mean?
It means that they weren't focused on short-term stock price movements. They were looking for solid companies with strong fundamentals. Companies that were well-managed and had a history of generating profits.
Oh, yeah.
They weren't just buying pieces of paper, they were buying pieces of businesses.
So they were looking for long-term value, not just a quick buck.
Exactly. And that's a key takeaway from the intelligent investor. It's about being patient and disciplined, about doing your research, and about focusing on the underlying value of a business, not just the fluctuations of the stock market.
Okay, I'm starting to see the big picture here. It's not about trying to outsmart the market or time those ups and downs. It's about understanding the fundamentals of business and investing in companies that are built to last.
That's a great way to put it. And that's what makes Graham's principles so timeless. They're not about chasing the latest hot stock or trying to predict the future. They're about building a solid foundation for long-term investment success.
So after all this talk about the intelligent investor, I have to ask, is this a book that anyone can pick up and understand? Or is it only for people with a background in finance?
I believe it's a book that anyone can benefit from regardless of their background. Graham writes in a clear and accessible style, and he uses plenty of examples to illustrate his points.
But it's not a get-rich-quick scheme, is it?
Definitely not. It's more about building wealth slowly and steadily over time, just like those super investors of Graham and Doddsville did.
So it's about having a long-term perspective and not getting distracted by those short-term market gyrations?
Exactly, and about not being afraid to go against the herd.
You know, I think one of the most powerful messages in The Intelligent Investor is that anyone can be a successful investor.
I agree. You don't need a fancy degree or a team of analysts.
What you need is patience, discipline, and a willingness to learn.
And the ability to control your emotions.
Because fear and greed are the enemies of the intelligent investor.
Absolutely. When the market is crashing and everyone is panicking, that's when you need to remember what Graham said about Mr. Market.
Oh, yes, Mr. Market. I've heard about this guy. Who is he exactly?
Mr. Market is a fictional character that Graham uses to represent the stock market. He's a manic, depressive fellow who's always offering to buy or sell your stocks at a price that may or may not reflect their true value.
So when the market is crashing and everyone is selling, Mr. Market is offering to buy your stocks at ridiculously low prices.
Exactly. But you have to remember that he's not always rational. His mood swings can be extreme, and you don't want to let his emotions dictate your investment decisions.
So when the market is euphoric and everyone is buying, Mr. Market is offering to sell you stocks at ridiculously high prices.
Right. And that's when you need to be cautious and remember what Graham said about the dangers of speculation.
It's all about being a contrarian, thinking independently, and not getting swept up in the hype.
That's the essence of being an intelligent investor.
Okay, I think we've covered a lot of ground here. But before we move on, I want to make sure I understand one key takeaway from everything we've discussed so far. If you had to sum up the essence of the intelligent investor in one sentence, what would it be?
I would say this: invest in businesses, not in the stock market.
That's a powerful statement. It really gets to the heart of what Graham was trying to teach.
It does. He wanted investors to understand that the stock market is not some abstract entity. It's a reflection of the real-world businesses that make up our economy. And when you invest in a stock, you're investing in a piece of that business.
Okay, so let's move on to some of the other key concepts from The Intelligent Investor. Let's talk about
One of the most important concepts in the book, the difference between a company's book value and its intrinsic value.
Okay, this sounds interesting. I've heard these terms before, but I'm not sure I fully grasped the distinction. Can you walk me through it?
Absolutely. Book value is a pretty straightforward accounting measure. It's basically what's left over if you were to sell all of a company's assets and pay off all its debts.
So it's like a snapshot of the company's net worth at a specific point in time.
Exactly. But here's the thing. Book value doesn't always reflect a company's true worth.
How so?
Well, it doesn't take into account things like brand recognition, customer loyalty, or the quality of its management team. That's where intrinsic value comes in.
So intrinsic value is a more holistic measure.
Precisely. It's an estimate of a company's true worth based on its future earnings potential, its competitive advantage in the marketplace, and a host of other factors that aren't always captured on the balance sheet.
I see. So a company's intrinsic value could be much higher than its book value if it has strong brand recognition, a loyal customer base, and a talented management team.
Exactly. And that's why it's so important for the intelligent investor to do their research, to dig beneath the surface and understand what truly drives a company's value.
So if we're looking for companies that are undervalued, we should be looking for those whose intrinsic value is significantly higher than their book value.
That's a good starting point. But remember, it's not always easy to determine a company's intrinsic value. It requires careful analysis and a bit of judgment.
It sounds like this is where that margin of safety concept comes into play again. We want to make sure we're buying at a price that's low enough to protect us from potential losses, even if we're not entirely sure what the company's true intrinsic value is.
You've got it. The margin of safety helps to mitigate the risk inherent in any investment decision.
Okay, so we've talked about book value, intrinsic value, and the importance of the margin of safety. What are some of the other key concepts that Graham outlines in The Intelligent Investor?
Well, he spends quite a bit of time discussing the concept of dividends.
Dividends, those are the payments that companies make to their shareholders, right?
That's right. And Graham believed that dividends are an important indicator of a company's financial health.
But aren't there companies that don't pay dividends even if they're profitable?
There are. And Graham acknowledged that there are valid reasons why some companies choose to reinvest their profits rather than paying them out to shareholders. But he cautioned investors to be wary of companies that consistently fail to pay dividends, especially if they have a history of poor management or questionable accounting practices.
So a consistent track record of dividend payments can be a sign of a well-managed and financially sound company.
Exactly. And for the income-oriented investor, dividends can be a valuable source of cash flow.
Makes sense. Now, I've heard that Graham was a big proponent of value investing, but what exactly does that mean? What are the key principles of value investing?
Value investing is all about finding companies that are trading for less than their intrinsic value. It's about buying those bargain stocks that the market has overlooked or mispriced.
So it's kind of like treasure hunting.
You could say that. The value investor is constantly searching for those hidden gems, those companies that have the potential to generate significant returns over time.
But how do we actually find those undervalued companies? What are some of the specific techniques that value investors use?
There are many different approaches, but some common techniques include analyzing financial statements, screening for specific metrics, reading industry publications and analyst reports, and attending industry conferences and events.
Okay, let's break those down one by one. What's this about analyzing financial statements?
This is all about getting into the nitty-gritty of a company's financials. You're looking at their income statement, their balance sheet, and their cash flow statement to understand how they're making money, how much debt they have, and how they're managing their cash flow.
Sounds like it requires some accounting knowledge.
It does to a certain extent, but there are resources available to help investors understand the basics of financial statement analysis. And once you get the hang of it, it can be incredibly insightful.
Okay, so financial statement analysis is one technique. What about screening for specific metrics?
This involves using databases and screening tools to identify companies that meet certain criteria, such as a low price-to-earnings ratio, a high dividend yield, or a low debt-to-equity ratio.
So you can set up these filters to help you narrow down your search and find companies that fit your investment criteria.
Exactly. And then there's reading industry publications and analyst reports.
So staying up to date on what's happening in the industries that you're interested in.
Right. You can glean valuable insights from these sources, especially if you're looking for companies that are operating in niche markets or are undergoing significant changes.
And finally, there's attending industry conferences and events. What's the benefit of that?
These events can give you firsthand access to company management teams, industry experts, and other investors. It's a great way to network, learn about new trends, and get a feel for the overall sentiment in a particular industry.
It's like doing your own on-the-ground research. So we've got these 4 techniques for finding undervalued companies. But once we've identified a potential investment, how do we actually determine how much it's worth?
That's where valuation comes in. There are various valuation methods, but some of the most common ones include discounted cash flow analysis, comparable company analysis, present transaction analysis, and asset-based valuation.
I'm familiar with discounted cash flow analysis. It's all about projecting a company's future cash flows and discounting them back to the present value to determine what those future cash flows are worth today.
Exactly. It's a powerful technique, but it can be complex and requires a number of assumptions about a company's future performance.
What about comparable company analysis? How does that work?
This involves looking at similar companies in the same industry and comparing their valuation multiples, such as their price to earnings ratio, price to sales ratio, or enterprise value to EBITDA ratio.
So you're essentially using the market's valuation of those comparable companies as a benchmark to determine the value of the company you're interested in.
Right. It's a simpler approach than discounted cash flow analysis, but it's important to choose comparable companies that are truly similar in terms of their business model growth prospects and financial risk.
Okay, and what about precedent transaction analysis? That one sounds a bit more specialized.
It is. This technique involves looking at past acquisitions of similar companies to see how much they were sold for. It can be helpful for valuing companies that are in industries where acquisitions are common, such as technology or healthcare.
So you're essentially looking at the prices that other companies have been willing to pay for similar businesses to get an idea of what your target company might be worth in an acquisition scenario.
Exactly. And finally, there's asset-based valuation. This is the simplest approach, but it's often the least accurate
Oh, Tom.
because it only takes into account a company's tangible assets, such as its property, plant, and equipment. It doesn't consider intangible assets such as brand recognition, intellectual property, or customer relationships, which can be significant drivers of value for many companies.
So it's a good starting point, but it's important to consider those intangible assets as well.
Right. And remember, no single valuation method is perfect. It's often best to use a combination of methods to get a more comprehensive view of a company's worth.
That makes sense. Now, throughout the book, Graham emphasizes the importance of being a patient and disciplined investor. But what does that actually look like in practice? What are some specific habits that the intelligent investor should cultivate?
Here are a few key habits that Graham recommends. Do your own research, avoid emotional decision-making, focus on the long term, and be patient.
Okay, these sound like solid principles for any investor, but let's dive into each one a bit deeper. What does it mean to do your own research?
It means don't rely solely on the opinions of others, whether they're financial advisors, analysts, or even your friends and family. Take the time to read company reports, industry publications, and other sources of information so you can form your own informed opinions.
So don't just follow the herd, think for yourself.
Exactly. And avoid emotional decision-making.
That's easier said than done, especially when the markets are volatile.
It is. But remember, the stock market is driven by emotions, and those emotions can lead to irrational behavior. Fear and greed can cause investors to buy high and sell low, which is the opposite of what you want to do.
So how do we avoid those emotional traps?
One way is to have a clear investment plan and stick to it, regardless of what the market is doing.
So it's like having a roadmap for your investments. You know where you're going, and you're not going to let those short-term detours throw you off course.
That's a great analogy. And speaking of staying on course, it's also important to focus on the long term. Don't get caught up in the day-to-day fluctuations of the stock market. Remember, you're investing in businesses, not in ticker symbols.
So we're looking for companies that are built to last, companies that are going to be around for years, if not decades to come.
Exactly. And finally, it's crucial to be patient. Don't expect to get rich quick. Building wealth through investing takes time, discipline, and a willingness to ride out those inevitable market ups and downs.
It's a marathon, not a sprint.
Exactly. And that's a key message that Graham conveys throughout The Intelligent Investor. It's not a get-rich-quick scheme. It's a guide to building wealth slowly and steadily over time.
Okay, so we've talked about the importance of being patient, disciplined, and focused on the long term. But what about risk? How does Graham view risk, and how can investors manage it effectively?
Graham understood that risk is an inherent part of investing. You can't avoid it entirely. But he believed that risk can be managed through diversification, margin of safety, and a thorough understanding of the businesses you're investing in.
So diversification is about spreading your investments across different asset classes, industries, and geographical regions to reduce the impact of any single investment performing poorly.
Right. And margin of safety is about buying stocks below their intrinsic value to provide a buffer against potential losses.
And understanding the businesses you're investing in.
That's about doing your research, reading financial statements, and learning as much as you can about a company's product, services, management team, and competitive landscape.
So the more you know about a company, the better equipped you are to assess its risks and potential rewards.
Precisely. And Graham emphasized that investors should focus on understanding the businesses they're investing in, not just on tracking stock prices.
It's about being an owner, not a trader.
Exactly. And that's a key distinction that Graham makes throughout the book. He believed that the intelligent investor should approach investing as if they're buying a piece of a business, not just a piece of paper.
Okay, so we've covered a lot of ground here, from the difference between book value and intrinsic value to the principles of value investing and the importance of being a patient and disciplined investor. But is there anything else that we should keep in mind as we navigate the world of investing?
Yes, there is. Graham emphasized the importance of understanding market psychology. He believed that the stock market is not always rational. In fact, he often compared it to a manic-depressive person swinging wildly between periods of euphoria and despair.
That's a pretty vivid image.
Yeah.
So how can we as intelligent investors avoid getting swept up in those emotional swings?
It's all about remembering that Mr. Market is not your friend. He's not there to guide you to the best investments.
Right.
He's there to exploit your emotions and tempt you into making impulsive decisions.
So when the market is booming and everyone is feeling optimistic, Mr. Market is there to whisper in your ear, buy, 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 even if those prices are inflated and unsustainable.
Exactly. And when the market is crashing and everyone is panicking, Mr. Market is there to whisper, sell, 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 even if those prices represent a bargain.
So the key is to not let Mr. Market dictate our decisions. We need to do our own research, think independently, and focus on the long term.
Precisely. The intelligent investor understands that the market is a voting machine in the short term, but a weighing machine in the long term.
Okay, I like that. What does that mean?
In the short term, stock prices can be driven by all sorts of irrational factors, like rumors, speculation, herd mentality.
Right.
But in the long term, the market eventually recognizes a company's true worth based on its earnings, its assets, and its ability to generate value for shareholders.
So we need to be patient and wait for the market to catch up to reality.
Exactly. And that's why it's so important to have a margin of safety. If you buy a stock for significantly less than its intrinsic value, you can afford to wait for the market to recognize its true worth.
Okay, I think I'm starting to get a feel for how Graham viewed the market. But he wasn't just a theorist, was he? He was also a practitioner.
Absolutely. And one of his most famous ventures was the Graham-Newman Partnership, an investment firm he co-founded in 1936.
Tell me about this partnership. How did it perform?
The partnership was incredibly successful. Over its 20-year lifespan, it generated an average annual return of about 20%, significantly outperforming the overall market.
Wow, 20% per year for 20 years. That's incredible. What was their secret?
They stuck to those core value investing principles that we've been discussing. They focused on finding undervalued companies. They maintained a margin of safety, and they were patient and disciplined investors.
So Graham's principles weren't just theoretical. They actually worked in the real world.
They did. And that's why The Intelligent Investor has become such a classic. It's a testament to the enduring power of value investing.
Okay, so we've covered a lot of ground today. But before we wrap up this deep dive, I have one final question for you. If you had to choose one key takeaway from The Intelligent Investor for our listener to remember, what would it be?
That's a tough one, but I would say it's this. Don't be a speculator, be an investor.
That's a great way to sum it all up. Speculation is about chasing quick profits, often based on emotion and guesswork. Investment is about building wealth slowly and steadily by focusing on the fundamentals of business and valuing companies based on their intrinsic worth.
Exactly, and that's the path to long-term investment success.
Well, I think we've given our listener a lot to chew on today. Hopefully they're feeling inspired to take a deeper dive into the world of investing and perhaps even pick up a copy of The Intelligent Investor themselves.
I agree. It's a book that can truly change the way you think about investing.
Well, thank you so much for joining us for this deep dive. It's been a pleasure exploring the timeless wisdom of Benjamin Graham with you.
The pleasure was all mine.
And to our listener, thanks for tuning in. We hope you found this deep dive insightful and empowering. Remember, you don't need to be a financial expert to be a successful investor. You just need to be an intelligent investor.
Well said.
And until next time, happy investing.